All right, let's talk about driving in New York. If you own a car here, you already know the deal. It can feel like you're paying a second rent check every month, right? It's just crazy expensive. So, in this explainer, we're going to dig into why it costs so much, and more importantly, we're going to give you a real, practical guide to cut down those insurance and loan payments. Let's jump right in.
Okay, and right off the bat, I want you to have these resources. All the numbers and data we're talking about today come from our source, My Financial Programs. You can actually go to these links and check out live up-to-the-minute rates for both car loans and insurance. So definitely keep those handy. So here's what we've got on tap. First, we'll tackle the big picture, New York's car cost challenge. Then we'll decode the mysteries of NY car insurance. After that, it's all about action, how to lower your premium and snag the best car loan. And we'll finish everything off with a super simple smart buyer checklist.
All right, section one, let's dive into New York's car cost challenge. Seriously, what is going on here? Why is driving so expensive?
Okay, let's start with a number that's, well, it's a bit of a gut punch. The average cost for full coverage in New York State is around $3,200 a year. Yeah, you heard that right. That's anywhere from 10 to 45% higher than the national average. But here's where it gets really wild. That number is just an average. It changes dramatically depending on your zip code. Just look at this gap. It's insane. If you live in Ithaca, you might be paying something like $69 a month for insurance. Pretty reasonable, right? But take that exact same driver with the exact same car and move them to Brooklyn, and suddenly their bill jumps to $277 a month. That's a $200 difference every single month. This is actually one of the biggest upstate-downstate insurance divides in the entire country.
So, that leads to the big question, why? Why is there such a massive difference? Let's get into our second section and decode what's actually driving your insurance rate here in New York.
You might think it's your driving record or where you park, and those things do matter. But believe it or not, the single biggest factor affecting your car insurance rate in New York is your credit score. It's a huge deal. As you can see here, a driver with poor credit can end up paying almost double, nearly 88% more than someone with good credit for the very same coverage. It's wild. And here's what that looks like in cold, hard cash. Let's say you've got a new car, something under 30 grand. If you have excellent credit, you're looking at maybe $310 a month. But if your credit is in the below fair range, whoa, that shoots up to $692. That's almost a $400 difference every single month for the same car, just because of your credit history. Okay, another big piece of the puzzle is New York's no-fault law. It sounds complicated, but here's the gist. The state makes you carry a specific minimum coverage, known as the 25-50-10 rule. But on top of that, you also have to get uninsured motorist coverage, and this is the big one, $50,000 in personal injury protection, or PIP. Basically, PIP covers your own medical bills if you're in an accident, no matter who caused it. And because everyone has to have it, it just adds to the baseline cost for all drivers in the state. All right, so we've talked a lot about why things are so expensive. Enough of that. Let's pivot to what you can actually do about it. Section 3 is our tactical guide for lowering that insurance premium. So, one of the first big decisions you have to make is new car versus used car, and financially, it's a real balancing act. With a new car, you're going to pay more for insurance. That makes sense, it's worth more, but you'll probably get a better interest rate on your loan. On the flip side, a used car is cheaper to insure, which is great, but the loan to buy it will often come with a higher interest rate. You gotta weigh which one works better for your budget. Making smart choices about your coverage can save you a ton of money. So for a new car, you're definitely gonna want gap insurance. But here's a huge tip. Get it from your insurance company, not the dealership. It's usually just $20 to $40 a year through your insurer versus hundreds from the dealer. Now, for a used car, there's a handy guideline called the 10% rule. Here's how it works. If the annual cost of your collision and comprehensive coverage is more than 10% of what your car is actually worth, it might be time to think about dropping those coverages. Okay, I really need you to pay attention to this slide because this is a huge risk for a lot of drivers. The state minimum for property damage is only $10,000. Think about that. The average new car costs almost $50,000 now. So what happens if you cause an accident and total someone's brand new car? Your insurance pays the first $10K, and you could be on the hook, personally sued for the other $40,000. It is a massive, massive financial gamble to only carry the state minimum. All right, let's switch gears to the other big cost, your car loan. And just like with insurance, it's all about finding that best possible rate to save you money in the long run. And surprise, surprise, credit is king here too. It's the same story all over again. For a new car loan, if you have excellent credit, you might land a rate around 5.17%. But if your credit is just fair, that rate could easily jump to almost 7%. That might not sound like a huge difference, but trust me, over the life of the loan, we're talking about thousands of dollars in extra interest payments. So, where do you go to get the best loan? Well, it depends on your credit. And this is interesting. If you have excellent credit, the car dealership can often give you the best deal because they have access to special manufacturer incentives. But for pretty much everyone else, if your credit is in the good or fair range, your best bet is almost always going to be a credit union. They consistently offer the most affordable rates. Okay, so to make sure you're in the driver's seat when you go to buy a car, here is your 4-step game plan. Step 1, know your credit score before you walk into any dealership. Don't let them be the first to tell you. Step 2, get pre-approved from a few different lenders, especially a credit union. This is your leverage. Step 3, go for the shortest loan term you can actually afford. You'll pay way less in interest. And finally, step 4, put down the biggest down payment you can manage. The smaller your loan, the better your rate is likely to be. Phew, we have gone through a lot of information. So let's boil it all down in our final section, your smart buyer checklist. These are the key things you need to remember. All right, if you only remember 5 things from this whole explainer, make it these 5. Number 1, know your credit score before you do anything. Number 2, get that loan pre-approval from a credit union. Number 3, shop around. Get insurance quotes from at least 5 different companies. Number 4, please raise your liability limits. Bumping it up to 100/300/50 costs less than you think and protects you so much more. And number 5, an easy win, take a defensive driving course. It's a guaranteed 10% discount on your insurance for 3 years. And that really brings us to the most important question of all. The absolute worst time to find out what your insurance doesn't cover is right after a crash. So I want you to really think about this. When you look at your policy, are you truly protected? Are you just doing the bare minimum to be legal on the road? For a much deeper dive and to check out those live rates that apply specifically to you, make sure to visit the links on screen from myfinancialprograms.com. Thanks so much for joining us.